Welcome to the Stock Play of the Day Overtime Edition. This week on Monday's Stock Play of the Day, we talked about the QQQ. That is the ETF that tracks the NASDAQ. Today, we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. This week in the Stock Play of the Day, we talked about a long call spread, a very simple momentum trade that we were trying to capture that was what was going on in the NASDAQ. So our vehicle of choice was the QQQ. We looked at buying a little bit in the money option contract and selling a little bit out of the money option contract. And what you're looking at right now is a summary of what a long call spread is inside the Ally Invest option playbook. So strike A, the more expensive strike we're buying, strike B, the less expensive strike we're selling. And we focused a lot on time premium, how much time premium we were buying last week versus how much time premium we were selling. Well, overall, if we look at the chart of what happened this week in the QQQ, we discussed that as far as technical analysis is concerned, one of the standard thinking behind it is that if you have a resistance level that gets broke, a lot of times that provides support. So we mentioned on the call, this little candle right here, this green candle was on Monday. The underlying stock came down and actually touched the old high in the QQQ, and we focused on that. We said, well, we did have a channel that was a very bullish trending channel ever since the March lows. All of a sudden, we got the market just being very nice, if you will, and trending to the upside. We broke through the new high. We struggled a little bit. We still stayed within the channel, but then the other day, we actually had a break out of the channel, but the old high did exactly what it was supposed to do, and it provided some support. So now I haven't touched this chart since Monday, and you see that the market has actually ran up. We got the bounce off of the support level, and now we're heading towards the upper end of the channel. So today's call, or I should say video, is going to be short and sweet in that the market did what we'd like it to do. So when that happens, it's a very simple summary of the stock the play that we did on Monday. So right now we have the stock at 252.83. It's up $2.32 on the day, and this is an ETF. We went out to the July 17th expiration. So we gave ourselves a little bit of time on this. It still has 15 days remaining, and this is the call side of our chain. The strike that we bought was the 240 strike. The underlying stock was at that point in time, let me check here, it was at 241.81. Okay, 241.81. So with that said, this option contract was a little bit in the money. And then we went up and we sold the 245 strike, and that option contract was out of the money. Now we see, by just looking at the blue shading, that both of these option contracts are in the money, and they're both in the money quite a bit. So if we scroll down and look at the price of our long call spread right now, currently the midpoint is at $4.20. Now, the maximum you could make on this trade is the width between the strikes, or $5, 245 minus 240, minus what we paid for this trade. And overall, we paid $2.80 for this trade. So we had $2.20 worth of upside. We've captured a lot of that. There's still 80 cents left in the trade, and the underlying market is up. But we're going into a holiday weekend. We're going to have a few days off. Some news could break. Overall, I would just look to try to close out this trade. So how would we do that? If we had this position on and we didn't want to, and tomorrow the markets are going to be closed, so we got a 3-day weekend coming in. How could you close it out? All you would do is take the sell to open and you'd make that a buy to close, and you would take the buy to open and you would make that a sell to close. And then that would get you the midpoint. You'd click on that. You'd try to trade it somewhere close to that $4.22 level, and you'd hit the preview order and you would send that order down to the trading floor. Now, let's just look at the profit and loss graph real quickly here to finish up our overtime edition. We see this, based on today's numbers, this is what the profit and loss graph looks like. This is at expiration. This is currently. So you see that there's still a little bit of room here. And as the market continues on up, this line is going to continue towards the expiration graph, the dotted line. But right now, here's where our risk is at. Because there's a lot of time premium left, we still have basically a flat line, not a lot of curve in that line. Now, if you wanted to wait, let's say you waited 7 days, we'll cut it down to 8 days. Notice I'm changing the days to go here. Now, all of a sudden, this line comes a little closer. We go down, let's do it to 2 days remaining. And now we're basically at the maximum on this trade, if the underlying stock would stay here. But if you don't close out the trade, you still have all the risk to the downside. So very simple, straightforward. The market did what we would like, what we wanted it to do. So the long call spread is looking good. Think about closing it before you go into the weekend. And that's it for this edition of the Stock Play of the Day Overtime. Please make sure you click subscribe and ring the bell so you get all the alerts for the next Stock Play of the Day. And I want to make you aware that this Monday, we will not have a Stock Play of the Day. We'll be taking a little bit of vacation time for the next week. So there will not be a Stock Play of the Day on Monday, but we'll be back the following week, same time, same place on Ally's YouTube channel. Thanks for coming.